because I'm going to show you exactly how we trade the gap profit. We'll show you guys examples of trades we just did today, okay? So there's going to be no cherry picking here. So without any further ado, I would say let's get started. The only thing I'll quickly say before we get started is that everything that I'm about to show you here today is absolutely true. I am not showing you any hype here. This is 100% exactly as it is showing it to you. I'm not into, and the reason I'm saying this is because I feel like I come across a lot of hype strategies out there. I don't know if you guys ever come across stuff that just doesn't seem to be just seems to be too good to be true. This is absolutely true. I'll back it up. I'll show you examples of everything, even for trades today. So just wanted to quickly lay that out there. So having said that, I'm good to go if you guys are. Cool. Okay, well, again, welcome to today's webinar. And obviously, we talk about my best trading strategy for trading the gap, which is really what it is a cash flow and income strategy. Is anyone here interested in cash flow and income? Probably, right? So the kind of stuff we're going to be talking about is the following. For example, in this trade here in shares of NVIDIA, we had a trade that lasted less than an hour, which is kind of the average here for this kind of a trade. Made a quick 25% return, which came to $269. You can see this is the exact trade that we did. And this is the gap that filled. Again, we're going to talk about this all in very, very exact details. Or a trade like here, $450 were made in just 25 minutes, which is a 36% return. Again, you can see the exact trade here, and you can see how that gap nicely filled. Now, I guess the question I have for you is, what would you do with an extra $200 a day, or maybe it's $500 a week, or an extra $4,000, $5,000, $10,000 a month? And of course, that money is all relative to your needs and sort of your standard of living. But I think we could probably all agree that a little bit of extra cash flow, or maybe another source of income, would go well. Or maybe you're retired and you want to have a supplemental source of income. Those are all viable reasons to me to do the gap trade that I'm about to show you. Maybe you want to, do more weekend getaways, or have some more dinners with your friends and family and significant other. I mean, those are all valid reasons to kind of have a little bit more extra cash. So you want to be a trader, right? And you love the stock market, you like that action, and you want some sort of steady source of cash flow from the markets. And the reality is that most people neither have the time nor a repeatable strategy that actually works. And like I said before, just beginning, I think there's a lot of misleading strategies being taught out there that really don't stand any chance of actually working. And this is absolutely true. What I'm about to show you, this really, really works. So stay tuned and listen to what I have to say here. Just a bit of a word on how my story about the gap is. Early on in my career, I was told that the gap is crap. I was working at JP Morgan at the time, and my managing director, who I actually just had lunch with again yesterday, bumped into him for the first time in a long time. He told me that, Serge, you got to stay away from this stuff. It's totally crap. It doesn't work. And, any sort of steady profits from this one trade are simply not possible. But the fact is that the gap is real. It's very tradable, and it's extremely highly profitable as long as you do it correctly. And that's exactly what I'm about to show you here over the next bit of time here today. So I have certainly been able to prove my managing director, or my former managing director, very, very wrong on his opinion about that strategy, and many, many other people along the way. So the agenda today is, we're first going to give you guys a little bit of backdrop of what it means to have a high probability strategy, which I think is important. We'll then look at gaps, the whats and whys, and then of course we're going to go into details of the exact strategy. And ultimately we're going to go and show you a lot of examples, including trades that we just had set up today. And of course, we'll do Q&A. So if you guys have questions, please, I would ask you to please wait until we get to the Q&A part, because if you shoot the questions through the presentation right now, then I might get kind of sidetracked, and then it's not really fair for other people who are listening at the time. So what we'll do, we'll certainly answer all your questions. Just please wait until we get to the Q&A session. So excellent. Thank you very much. Cool. Okay. Well, again, like we said before, I think a lot of people, want to have an additional source of income here or make some additional cash flow for the markets, but a lot of people lead very busy lives. And so the last thing that I would want you to do is spend 6 to 8 hours a day in front of the computer day trading. Most of us lead very busy lives between work and family and life. And so life doesn't really happen in front of your computer. At least that's been my experience over the past 21 years as a trader. So you got to get your trades done and move on. And so what I always tell people is that, listen, if you're staring at screens for more than 1 or 2 hours a day from a trading perspective, not a research perspective. You can do research all day long if you don't do this full time, but purely trading, then I think the odds are extremely high that you're over trading and probably overthinking. Would anyone here consider themselves as falling into this category? You don't have to raise your hand. You can probably just nod to yourself if that's your case. And again, this is just my experience of the past 21 years that if you're staring at the screen all day long, you probably end up actually losing money over time. So what I would like you to ask you to do is to stop wasting time with what I consider to be low probability trades. There are countless trading strategies out there, and I'm sure you've come across plenty of them, but many of them are very, very low probability. So the question you have to ask yourself is, why would you waste your time with anything less than a truly high probability strategy, right? Think about that for a minute. Why would you waste your time with anything that is less than a truly high probability strategy? It just doesn't make sense, right? So let's talk about high probability strategies in the broader sense. Well, first of all, they exist in all time frames. They exist intraday as well as in the long term. Like, for me, for example, a long-term strategy, just as an example, that's high probability would be to buy a broader U.S. stock index after a 20 to 30% drop, just as a simple example. In immediate term, I think, to me, I don't know if maybe some of you are familiar with my beta reversal swing trades, like those signals are extremely high probability. And of course, intraday, we're about to show you the gap. So with that, I have to give you a quick word on day trading. And what I'm about to show you is a day trading strategy, but you have to understand that, broadly speaking, smart money people and very experienced traders, for the most part, don't consider day trading to be a high probability strategy over time. If you want to be day trading, you need to make sure that you focus on a very specific strategy or a trade setup that takes place at a very specific time period each day. Just like I said before, it's not a good habit to sit there all day and click around the markets all day, but there's got to be specific things you're looking for at a specific point in time during the day. And so as a result, I also think, again, this is just over the past 21 years as a trader on Wall Street and now running my own company, I think it's best doing this kind of a trade as a supplemental cash flow or income trade, which I think plenty of you are probably interested in. So having said that, let's look at the one-day trading strategy that I consider to be valid, and it's the one-day trading strategy for non-day traders. But of course, as you'll find out here shortly, lots of day traders love this one too, because in fact, a lot of the great day trades are all based around this thing called the open gap. And so, like I always like to tell people, I don't always day trade, but when I do, it is the gap. And again, you guys will see why in just a few minutes. So let's go through a few basic statistics about this strategy. First of all, and this is really important, understand that this strategy has about an 85 to 90% chance of probability if it's done correctly the exact way I'm about to show you. The time requirement is somewhere between 30 and 60 minutes per day on average. It certainly can be less. And it's about 2 to 3 times a week. You can have it take place 4 or 5 times a week, depends on how many opportunities there are, is kind of what we're looking for. So there's nothing hectic here. There's a very clear pattern to it, so you don't have to put your life upside down. So having said that, let's talk a little bit more about the gaps and what they are and why they exist, and ultimately why should we care. The gap is essentially, it exists due to imbalances between buying and selling pressure that are of fairly significant proportion. So the price will then tend to gap to an area of better equilibrium between supply and demand in the market. In other words, we could also look at the gap as being something that represents an absence of buyers, which is down gaps, or an absence of sellers, an up gap. So here's what a simple sort of gap looks like. You can see in this specific stock that this blue box here is where the stock gap lower. Again, this vacuum, this literally an air pocket in the chart, and it happens in all time frames, and you can see it happens on the upside. And when these gaps take place, sometimes they're very significant of proportion, but more often than not, they're actually not very important, and we can actually what's considered to be fading them for great cash flow. But again, we'll talk about this here more in just a minute. So why do gaps exist? Well, for the most part, gaps are news related. That data or that news can be economic, geopolitical news headlines, like we had today, for example, or corporate news, earnings events, analyst upgrades and downgrades, you name it. You can kind of, imagine all the different types of news. All those kind of things can gap a market up and down at the beginning of the trading day. So we're now specifically focusing or talking about stocks or ETFs, right, or indices of equities that have a trading hour rhythm to them, where the market will either gap up or down. And so these gaps create opportunities not only on an intraday basis, which is the focus of today's presentation, but just so you know, they also can give us hugely juicy opportunities for perspective for trades that last, multiple days, weeks, months, or even more. So that's another little side bonus, and I'll teach a little bit later on how you can learn more about that. So the thing about the gap is that the reason for the gap actually matters. And I see a lot of people talk about the gap, but very few people care to admit that the reason actually matters. So not all gaps are created equal. The news really does matter. Like, for example, to me, a U.S. jobs report up or down gap, or an up or down gap in the market after a U.S. jobs report, for example, tends to, at the margin, be a little bit more important than your average analyst upgrade or downgrade. Again, this is just an example, and it's on average, but that's a simple way of explaining that. Now, has anyone in here ever heard, by show of hands, by type a yes if that's the case, please let me know if you ever heard that gaps all fill over time. Has anyone here ever heard that? I'm just curious. Okay, so by my estimate of having traded the gap now for I don't know how many years, probably 11 years or 12 years, something like that, I will tell you that's simply not true. And if you don't believe me, pull up a chart of the S&P 500. Go back to 2009 and tell me if there's gaps that are still not filled, and you'll find a lot of those. Or pull up a chart of Facebook, go back to 2013, you'll find plenty of stocks that have never filled, and quite frankly, probably never will fill. So you can go back in time and you'll find that that's simply not true. In fact, I think it's actually very dangerous to believe that all gaps fill. In fact, it's one of the reasons why I lost a lot of money a number of years ago when I actually first started trading the gap. So that's really important. So by my estimate, it's about 7 or 8 out of 10 gaps that will tend to fill over time, but certainly they don't fill 100% of the time. Now, the types of gaps is important. What I'm going to talk about today here, for the most part, is going to be focusing on what's called, common gaps, or sometimes exhaustion gaps. And what these common gaps exhibit, they're basically just gaps that take place with no specific, no major news line that will break the back of any chart, or no major sort of significant technical breakout of things. Like, for example, here, like this is a common gap. You can see there's a well-defined trading range, and you can see here in this case the stock gapped up a little bit, and here too it gapped up a little bit more, but this actually still was well within the trading range if we were to go back a little bit more. So those are the kind of gaps that we're trying to focus on when it comes to fading this gap for our sort of weekly, monthly, quarterly cash flow type of strategy that we're doing. Like I said, there are other types of gaps, and I'll show you guys a little bit later on how you can learn more about the other types of gaps, which actually also give us tremendous opportunities. But the question right now is, why do gaps actually close? And the easiest way to explain is by saying that in the absence of meaningful news, an institutional investors are going to try to get a fairer price on the following day if the price, let's say, gaps up, right? So let's say, for example, a stock is trading at $50 on a Monday, and then on Tuesday morning it opens up at $51 on no meaningful news at all relating to that stock or ETF, let's say. Well, all else being equal, then traders are going to try to get a fair price to buy that stock, so they're going to try to fade it and push it back to the previous day's close. That's a very simple explanation, but if you kind of really look at the market makers and stuff like that, that really is probably the closest to the truth. Next question is, why do we care? Why do we trade the gap? Well, obviously, we've talked about this, beautiful opportunity to generate weekly or monthly or quarterly cash flow. But what you'll find over time, the more you stick to this trade, is it's also for great risk management. And ultimately, and this is the best part of it all, to me ultimately, is that you gain unbelievable perspective and feel for the market. And again, we'll look at some examples of gaps that we're setting up to fill just today, according to our parameters, and you can see how great a feel that gave us for the market even just today. So let's talk about qualifying a gap for a fade trade, and now we're going to start looking at the examples. So market gaps in general, like we said before, they tend to fill between 70 and 80 or so % of the time. However, by my estimate, about 80 to 85% of what I call or consider qualified daily gaps will tend to fill. And take it out a step further even, about 90% of so-called half gaps, which is the 50% of the gap, tend to fill over time. Now you might be saying, Serge, well, that's not a really big difference between, say, 70 to 80% up to 90. Well, trust me, historically or statistically speaking, I should say, that is a huge difference. That's going to make a massive difference in your P&L over time. So this statistics and the way we do this by focus on qualified daily gaps is going to allow us for beautiful, steady base hits for these cash flow profits. And ultimately, what's going to happen if you stick to the system and you stick to the rules, and that's all you have to do, then every once in a while you're going to get a huge home run, and I'll show you guys why and how that sets up. So here are the requirements for qualifying a gap fade trade. Number one, it has to be a common gap, like I just said, which is basically means that it should be a gap that came on no major news as it related to that stock or index or ETF, and it shouldn't have made a major technical breakout or breakdown on the chart. That's important. So let's qualify this a little bit more, and I think the important thing here right now is to understand when is it a good time to fade the gap. And you guys may want to take a picture of this slide here, or maybe you want to write down this. This is quite interesting. Now, in my experience of trading the gap now for many years, is that the best odds for a gap to fill are Tuesdays, Wednesdays, and Thursdays. The worst odds of the gap fill are Mondays and Fridays. Now, Mondays can be affected a little bit by what we call merger Monday, where we get major merger news and the market kind of rips in one direction or another. And then Fridays are a bit of a wild card. We have options expiration and the weekend anticipation. And so really it's best to focus on Tuesday, Wednesday, and Thursday. Now, to be very clear, the odds of a gap closing on Monday versus, say, Tuesday, or Monday and Friday versus the middle of the week, it's not a hugely different, statistically worse. So it still works very, very well. It's just, I just think it's important to know that the best odds are Tuesday, Wednesday, Thursday by my experience. So having said all this, I think it's time to start looking at the actual strategy. You guys ready for this? Okay. So let's look at the actual strategy. And again, our goal here is to generate some additional weekly or monthly or quarterly cash flow. And what the strategy is here, it's simple, it's straightforward, it's repeatable, most importantly. And the odds are going to work out very favorable over time. As you'll see, There's no stress, and the trade is on any given day. It's either going to work or it doesn't work on any given day. It's that simple. So on any given day, one of three things can happen, assuming, of course, that there's a gap. Either there is a gap and it closes in full, or it closes partially. A third or a half is most common. Or the market gaps and just runs in the direction of the gap, and it never actually attempts to fill any of that gap. Yeah, I mean, so that certainly can happen as well, and there actually is a beautiful trade strategy that we can focus around that as well. So here is what this all looks like. So what you guys are going to see here from here on forward for the charts for today, the charts are going to be based on intraday. So obviously, since it's a day trading strategy. So the vertical line here, this black line, is marking a new day. So this is day one. So this, let's say this is a Monday, right? So then this, of course, would be Tuesday. And what you can see here is a gap. So the daily open gap definition is that it's the difference between the prior day's closing price, which is here, right, and the following day's opening price, which is here. And so the strategy, at its very simplest terms, is to go short when the market gaps higher, or to buy or go long if the market gaps lower. So in this case, you can see the market gap lower, so we're trying to make a bet that the market will ultimately mean revert, as it's called, back to the previous day's close, and you can see how that so nicely happened here. Okay, so how does it all work? Well, the general rules to follow are as such. Number one, I think it's really, really important to use candlestick charts. I personally like to use 5-minute charts, which is more conservative, so 5-minute bars. One could use 1-minute bars. It's more aggressive. It'll work, but it's a bit more aggressive. And if the gap is large enough, you could actually even use 15-minute charts for confirmation. In fact, there was a couple of trades today that were setting up where the 15-minute chart was of great assistance for the trade. So let's talk about the strategy. Here is the exact entry rule. In order to trade this successfully, what we need to do is we need to fade or sell up gaps or buy down gaps upon either one of the following two scenarios happening. Either on the first bearish reversal on it's an up gap, or bullish reversal based on a down gap, or if the stock or ETF breaks below the first 10-minute range, which is the first 2 5-minute bars. Again, I'll go through all this here in great detail in just a second, or the opposite, of course, on a down gap. So again, we'll go through a lot of examples here in just a second, but understand what the profit targets are as well. The profit targets are as follows. I like to go for what's called the half gap fill, which is, to me, what I consider the best odds for profit. So here, for example, you can see the market gapped higher, then we had a nice bearish reversal, and this market quickly went to the half gap fill. You can see this is visibly just about the halfway point of the gap, right? You guys can see that? So that's my first profit target personally. That's usually the one I go for. But profit target number 2, which is a little bit more aggressive, is called the full gap fill, of course, which then you wait until the full gap actually fills, which is down here. And you can see that more or less happen here on that day. And stop loss is the same thing. I like to have a conservative version and a more aggressive version. So the more conservative version is that you get out upon any strong bullish or bearish reversal following the initial entry point. So like in this example, we had a nice entry point here, the bearish reversal, and then the bullish reversal that triggered was here. That would have been a stop loss for me. But in my case, for the half gap, I've already reached half the gap, right? And if you want to be more conservative, you basically use the bullish reversal highs, in this case, the bearish reversal highs, or if it's a down gap, the bullish reversal highs as the stop loss. Okay. So again, we're going to go through all this in great detail right now. So step by step, what we're going to be doing is we're going to be locating the first bearish or bullish reversal, depending on whether it's an up gap or down gap. and then we're going to wait for the market to, and then we're going to buy the market if it's a down gap or sell the market if it's an up gap. And we can do the same thing, i.e. fade the open gap also if we break above or below the 10-minute range. So let's have a look at this in the charts. So again, let's go through the steps. In this case, you can see we had a nice up gap on this example. And I'm going to show you guys trades that just happened today so you guys can see that I'm not cherry picking this. And I'll show you also exactly how to find these gaps in just a bit as well. So here's a nice up gap, and you can see in this case there wasn't really a strong bearish reversal. Yes, the market kind of got a little bit tired up here, but it didn't really just give us a screaming exhaustion buying sort of a signal. But what did happen is that a bit into the trading day, I guess maybe what is that, half an hour or so, the market broke below its 10-minute range. What does that mean? That is the first 10 minutes or the first two 5-minute bars. This is 5-minute bar number 1, right? These are 5-minute bars. The second 5-minute bar is this one here. So the range of these 10 minutes extends from here, that's the high of the second 5-minute bar, down to the low of the first 5-minute bar. And you can see how we broke below it here on this bar. You can see that, this red bar here. And from there, very quickly, we filled the half gap, which is about here, and then boom, end up filling the full gap. Okay? Now, not all of these trades are going to trigger. Sometimes you get an up gap or a down gap, and neither happens. Neither a strong bearish reversal, nor a break below the 10-minute range. In which case, if that happens, give it 30, 40, 50, maybe 60 minutes at most, and just leave it be and look for another opportunity in the meantime, of course. And I'll show you guys exactly how that works. But here you can see this trade never triggered, right? A beautiful up gap, the 10-minute range, but we never broke below it on a 5-minute closing basis below the lows of the range, right? It never happened. And if the trade doesn't happen until let's say 10:30, 11 a.m., you simply leave it be. There is no reason, and Eastern time, excuse me, that's New York time. You simply leave it be. Okay, so let's look at some more examples. Here's a good one, and you can see what happened here. This is exactly one of those strong bearish reversals. And in fact, this is an absolute beauty when this happens. And we had, I think one of those just happened yesterday or something. I can't remember. We did it. And you can see not a very big up gap, but an up gap nonetheless. But you can see very quickly the market reverses on the second 5-minute bar. Can you guys see that? That strong bearish reversal? You guys see that? Yes, no? Right? Really nasty. I mean, the market just gapped up for 5 minutes and then quickly, boom, reverse lower. When that happens, guys, and this is a bit of a bonus tip I'll give you, you can literally go in, short the market, set the timer for 30 minutes, and stop yourself, or not stop it. Most of the time it's going to be profitable, and ring the register 30 minutes later. It happens so many times. Every time that happens, it's unbelievable. That's really, really great. But how about this? And just to demonstrate this, there's also here, in this case, a very small gap, but I just want to demonstrate some points here. You can see we have a down move and then a very strong bullish reversal. See the seller exhaustion, follow through buying, and ultimately, boom, the market reversed back to the previous day's close, right? Or how about here? Here you can see a very strong and visually obvious bearish reversal taking place. You can see a nice up gap. The market rallies for 3 5-minute bars, right? So 15 minutes, but then boom, quickly reverses lower, follow through buying, and the rest is history. Quickly fills the half gap, and then quickly fills the rest, right? So that is a basic introduction to the gap. Now, there's a few more key ingredients you need to understand, and one of them, of course, is how do you find gaps that are actually stand a good chance of closing that any given day. So what I want to give you right now first before we continue is some idea of what the kind of instruments are that you could use to trade this. You can use things like ETFs like the S&P 500 or even levered ETFs like the SPXL and SPXS and so on. Russell 2000. Single name stocks, of course, right? Any Any single name stock with good liquidity is game for that for the most part. You can trade futures on it, and that's a great way of doing this strategy with futures. S&P minis, all those kind of things. Or what I like to do a lot as well is the sector ETFs. So this is the S&P 500 sector ETFs, exchange traded funds. That works very, very, very well. So let me show you guys a few more examples here, and I'm going to show you guys some trades as well in just a few minutes that happened just today, and so you can see that I'm not cherry picking on all this stuff. So what I want to do first is go through the trade that I showed you guys at the very, very beginning in the first minute or so of the webinar, which was in NVIDIA, okay, and how and why we made a quick $269 in under an hour. And this is I'm not cherry picking. This is just I'm showing you this example because NVIDIA is a name that everyone knows. So what you can see here, we had a very nice down gap. And actually, I'll bring you the chart. This is the actual chart of that day. And what you can see is that the market gap down, right? And the gap here is, let me just quickly mark it so you guys can see. It's from the previous day's close, right? And so this is kind of your gap. And what happened is we didn't really have an extreme bullish reversal, but we did have a push back above that 10-minute range. So the 10-minute range ranged from, let me mark that in, from about here, okay, to here, all right? And so as we started pushing above there on a 5-minute closing basis, which was here, okay, we had a beautiful clear entry point to go ahead, buy that option or that stock. In this case, we simply bought an at-the-money call option, and boom, you can see the gap filled very, very quickly, right? So that's the essence of how that works. And this is, again, that's exactly this trade here that I just showed you guys earlier. Now, the great thing is that I have a tool that you can use that shows you how to find these gaps that are likely to close on any given day, or even ones that are likely not to close. This is the same chart of the one of NVIDIA that I just showed you, but this is the daily chart. So this here is that day that I just showed you, and you see this little green arrow up here? This will tell you this was a down gap that's likely to close, hence a green arrow on top of the bar, right? So this is the gap. You can see how it closed. I just showed you in great detail. And here you can see on the daily chart that it printed this up arrow at the beginning of the day telling us the gap is likely to close. So I'll show you guys in a minute how all that works. But let's go through some more examples so you can understand the principle, and I'll show you guys a few gaps that we're setting up today. Here's shares of Intel. Again, beautiful down gap. You can see not a major exhaustion, a bullish reversal, but a nice push back above the 10-minute range. You see the first 5-minute bar, the second 5-minute bar. That's the range. We broke above it here. Boom, the gap closes, right? Or how about here in Amazon? You can see here a nice up gap. Not a major bearish reversal, but you could have done the trade based on that as well. What I like is we broke below the 10-minute range. First 5-minute bar, second 5-minute bar. This is the low of that range, and we closed just a touch below it, and boom, the gap closed, right? And by the way, this doesn't just work for me. We have a lot of clients who are using this very successfully. So, for example, one of our clients, Sebastian, he did this trade in ticker symbol OKTA, and he did exactly the same thing, stuck to the rules. He made $450 in just 25 minutes, which is a 36% return. Same exact rules, and in fact, he actually used this tool that I'm about to show you. Or in this trade here, he in DOCU, he made $200 in just under an hour, just a number of weeks ago when he told me about it. Same thing, the gap really quickly closed. How about here in MU? MU, by the way, guys, just so you know, MU, which is Micron Technology, great stock for gap trades. Just as a quick, a bit of a freebie, just so you know. Here you can see nice up gap. We break below the 5-minute range. A 10-minute range, and boom, the gap closes. Okay. Who wants to see some examples of things that work just today? So let me show you. I'm not even going to ask. Here, for example, is Twitter. Okay. This is today. This is today. All right. What happened today? 10-minute range. We broke up above it here. Okay. And boom, the gap closes. You guys see that? Yeah. How about, let's see, another one. The one I traded today was Microsoft. Let me bring that chart up. Same principle. Let me show you here. Microsoft today, okay? 10-minute range. We break above it. Boom, gap closes, right? How about the Russell 2000? Okay? We break above the 10-minute range here. Boom, the gap closes. How about Alcoa today? Half gap. Nothing tremendous, but again, it worked. How about XOP? This is an ETF that I like to follow a lot. Bullish, beautiful bullish reversal here today. You see this? Seller exhaustion, follow through buying, and we even broke above the 10-minute range. And then what happens? Boom, the gap closes, right? So you can see there's a very repeatable process here. Now the question, of course, is how do we find these gaps? How do we find these trades? Well, after trading these gaps for a number of years, I devised a tool to help me find these gaps because I was sick and tired of kind of just, clicking through the market all day long. So what I have is I call it the gap indicator and scanner. And what it does is it finds these gaps that are likely to close any given day, as well as the ones that are likely not to close any given day. So we'll talk more about this and what it works for in just a minute, but let me just show you how it works. So here's the daily chart of the S&P 500, and I showed you guys the chart of NVIDIA earlier, right? And you can see that it prints these green or red arrows above or below candles. So note this day, for example. This is the daily chart now. See how I printed a down arrow below the daily chart? Well, let's go look at the intraday chart and what happened. So this down arrow appeared at the beginning of the day, telling us that this gap is likely to close. So let's go to the daily chart, and that's the daily chart. You can see the S&P gapped higher that day, and then boom, the gap filled, right? So it prints these little arrows. But even better than that, we can actually scan for it, so we don't have to go look at individual charts and see which one has an arrow. But let me show you a little bit more. It also actually tells you when a gap is likely not to close. So here, for example, in Netflix, you can see this green arrow on top of the candle that tells you this gap is not likely to close, and in fact is likely to run. Would have been a beautiful opportunity to just buy the stock for what I call a gap and go. Or here, for example, in Amazon.com, you can see all these half gaps filled, and there were down arrows indicating us that that's going to work. So here is how the scanner looks like. It's 4 different scans, and you just have them set up on your desktop. So all I do every morning is I come in and look at these scans. I'm actually going to click out of this and show you the actual scan live right here, right now. These are the 4 scans. So on any given day, only one of 4 things can happen. You either have an up gap that's likely to close, right? You have an up gap that's likely not to close, right? You have a down gap that's likely to close, or a down gap that's likely not to close, right? So let me just show you how this works. So like today, for example, we had under down gaps likely to close, right? We looked at Twitter before. Let's just quickly go back to Twitter, just because that's a name that everyone knows. You can see, let me just quickly bring up the 10-minute chart or the intraday chart, right? So this showed up on down gaps that are likely to close, right? So that populated within the first 10, 15 minutes or so of the trading day. And sure enough, once it pushed above the gap closed, right? Now, if you go to the daily chart, you'll notice, this is the daily chart now, that on the daily chart, it printed this green up arrow on the daily bar, telling us that gap's likely to close, right? So we found it here on the scanner, right, telling us that it's likely to close. And that's what happened, right? Let me show you guys, I want to show you guys a few more examples so you guys can see how this works and, what the odds are. So again, like the odds, like I said before, are very, very high that gaps are likely to close. A name that I really like to trade for gaps is a stock called MU, which is Micron Technology, like I just said. So a lot of times that stock will actually show up on the scanner, and you're not going to be able to make money consistently just with that one stock, but it's something that a stock that works very well. So again, let me just show you this one more time so you guys can see this. All we do is we look for the opportunities here, and then wait for these gaps to trigger and actually fill. Again, that's Twitter that I showed you today here right now, and it's just as easy as that. Because the problem is, unless you have a tool like that, you're going to end up trying to trade a lot of gaps that don't actually fill. So how does this all work? What you can do is you can get this tool and the indicator and the scanner along with the course. It's called Trading the Gap: A Strategy for Predicting and Profiting from the Move. It's a multi-part video series. It includes the gap and the scanner. Okay, and I want to go through a lot more examples here in just a minute to show you guys how this works, and we'll take all your questions here in just a minute. So you're going to learn exactly how the strategy works, all the intricacies, and of course also how the indicator works. So you're going to learn how to trade profit from gaps, not just intraday, but also from a multi-day, multi-week, multi-month perspective. We have 25 to go at this price. It's $197. It's a one-time payment. There's no subscription fee. It's a one-time. You go to thestudytrader.com/gap. And I'll quickly type this in, and I'll show you exactly all the other stuff that's included here as well. First of all, what's included is a special bonus webinar series. The next one's going to take place on July 24th at 9:15 a.m. Eastern time in the morning, where we're going to be doing live gap trading with you guys on the line. We'll live trade it with you so you guys can see that we're not making this up. So I'm going to quickly type in the buy link here quickly. So this is /gap. Okay, let me just quickly go through a couple more things, and then we'll ask. And by you guys can start typing in any questions you guys have. Okay, so we do these bonus sessions, and we don't do them just once. There's a series of these. We continue doing these. Usually we do them once a month, and then we kind of stop for a couple months and do them again. You'll be invited for all these going forward. You're also going to be entitled to any upgrades on the scanner that we do and the indicator. So come back on July 24th, and we will show you the live trading of this, right? So you can ask all your questions there as well. Also, what I will do, I will throw in a free mentoring session, an hour mentoring session with you. I usually charge $400 an hour for these sessions, but I'll throw one in for free for anyone that's taken this today. So if you have any questions on not even just the gap, but any trading that you want in general for you, I'll throw in a personal mentoring session. So that's included as well. And again, it's a recorded video series, and what you're going to get in addition to within all that stuff is also, for example, I'll teach you how to do the midday trade. This is a beautiful trade that sets up around the mid part of the day as a bonus day trading strategy. I also teach you how to do the breakaway gaps, which is where you have the potential for huge winners, right? That's also included, and in fact, I'll show you guys how that works in just a minute. Again, you'll learn all the details of how to use gaps with technical analysis and swing trading, and even earnings season gaps, which are super, super important to learn how to do, and much, much more. So that's important to understand that gaps occur in all time frames. And you really need to have a tool to find when and how these gaps set up. Okay, so again, ideally what you do now, you get this right now. Again, we have 25 to go at this price at $197. It's a one-time fee. There's no recurring fee here. It's a 14-part video series, includes the gap scanner indicator, and we'll talk about that right now. And we'll go through all your questions in a minute. I'm sure you guys have a lot of questions, so please type them in right now. So Jay here, for example, sent us a note the other day. He said, I used the gap indicator for Alabama this morning, and it was down for the gap to close, and you made 25%. So a lot of people are using this very, very profitably. You guys are going to, by purchasing this today, you're going to be also joining that club where you'll meet all these other people who are trading this successfully. The gap indicator and scanner works for Thinkorswim, TradeStation, and NinjaTrader. Okay, that's what it works for right now. We are working on something called the dashboard, which will be available in a number of weeks from now. And that dashboard will have it included as well. So that's going to be then platform agnostic. And so once that's available, that'll be on our website. Then you no longer will have to have one of these platforms. But let's talk about all this a little bit more. Okay. So again, what you're going to do is you're going to come into the morning, and you're going to see these trades populate. So let me quickly go back to this, and I'll answer all your questions, you guys in just a minute. Just go ahead and start typing them in. So again, like today, for example, today the market gapped lower, so I was looking for opportunities to fade this gap. And Twitter is a name that I know very well, and is a name that I know trades very well, and so that quickly attracted me to look for it today. Oh, for example, yesterday. Sorry. Yeah, I'm just looking for so many questions. Yeah, so another one we did today, for example, was Alcoa. Excuse me, that's actually, I tapped in the wrong ticker earlier. Alcoa came up on the ticker, had a beautiful, beautiful bullish reversal. You guys see that? Came up on the scan, and it triggered right away a few minutes later for a beautiful gap fill today. Okay, so that's great question. So Hong Guys, sorry, I'm totally butchering your name. He's asking, do we scan for the gap immediately when the market opens? Excellent questions. Yes and no. The reason why this gap scanner indicator works so well is because we have a filter in there, and the filter looks for a minimum amount of volume. So until the stock has reached that minimum volume threshold, it won't show up. So the gap scanner starts to populate within the first, some stocks will show up right away the first minute or two, and then by the next 5 minutes, the next 10 minutes, and next 15, 20 minutes, you'll get a lot more things populating as more volume comes in. Because the gaps that we care about are not gaps that are going to fill in the first 1 or 2 or 3 or 4 or 5 minutes, right? So the gaps we look for are juicy. They're between, let's say 1 to 2% or so, and those are the ones that ultimately you want to focus on, and that's what's going to happen here. Does that make sense? Ev is asking a more specific question on the gap. Ev, that's a great question. To be honest, he's asking about like maybe scaling in and out of the trade, or that's a question you're going to get answered in the course. Okay, and also in the bonus webinars. It's a bit more involved. It's an amazing question you're asking, but I think it requires a bit more than just me trying to throw it out there right now. Okay, it's not that don't want to answer your question, but it's a bit more involved, and it's we go through it in the course, and we go through it in the online webinars a lot. Okay, so again, this is a 14-part recorded video series. It includes all the details you need to know about gaps in general. Ideally, what you do is you get this now, you come back and you watch all the videos, you install the indicator and scanner, and then you come back and you join us on July 24th for the next live webinar. If you want us to send you the past recording of the most recent one we just did, I think it was just a few days ago, you can get that as well. Charles is asking, does it work on Ninja 7 or 8 or both? I think it works on both, Charles. I think it works on both. Jay Tuck is asking, can this be set up to work with OTC? Are you talking about over the counter? Is that what you're referring to, or is that a specific trading platform that I haven't heard of? I have never heard of it. I've never heard what OTC is a broker. So no, the scanner and indicator works for, like I said before, right now it works for these platforms. Oh, I see. I got you. Okay. It works for Thinkorswim, TradeStation, and InTrader. But again, we are working on the dashboard, and the dashboard will, once it's ready in the next month and a half or so, is going to have that included. So that won't be. Then that's not going to be something that you'll have to have a platform for, if that makes sense. Yeah. Yes, you can install it on more than one computer for sure. You can install it on 3 computers for all I care. I don't care. Over the counter. Well, as long as as long as the symbols are showing up on your platform, you can scan for it. Tuck. Okay, so that's it. It shouldn't really matter, where you get the signals from, as long as it's. Does that make sense? I think you need it's a really good question, Alan. I think you need a live account in Thinkorswim. I think a paper trading account, it won't work. I think, but I'm not 100% sure. But you can fund a Toss account with like almost no money. Like it's literally like a joke. I don't know honestly, Alan, but I know you can fund for very, very little. I don't want to. I don't want you to take my word for it because I'm really not 100% sure. Okay. Peter's saying you can fund it with $200. Alan, thank you, Peter. I appreciate it. Yes, absolutely. Hong Gong, gosh, sorry, I'm sorry for butchering your name. He's asking, can you use it for swing trading? Absolutely, can use it for swing trading. But so what you're going to do is in this course, you're going to learn all about how these gaps work and how important they are for swing trading. Okay, that's part of the course. The course is divided up into part of the course is going to teach you how to do the gaps for day trading, and part of it for swing trading. Okay, and so that's all included in the course. And then you come back on July 24th. The webinar will be recorded as well, of course, as all the future ones. So absolutely, you can use it and understand, these gaps for that. So Ev is asking, so you always wait for 10 minutes before fading? For the most part, yes and no. It really depends. I mean, there's, like, for example, in AA today, which is Alcoa, which came up on the scanner today, okay, I did not wait. I didn't do this trade, to be fair. But this is because I actually didn't see it until a bit later on when it already filled because I was doing other trades. But you would not have had to wait. You would not have needed to wait 10 minutes, okay? This is what I call a strong bullish reversal, right? So it shows up on the scanner in the first few minutes, usually in a stock like that, which is a lot of volume, right? So again, let me go back to that. It'll show up here. So in this case, it showed up here. It's somewhere in here. I saw it earlier. And you can just go ahead. Does that make sense, Ev? Okay. Okay, sure. Let's the dashboard is. I'm just showing you guys. Like right now, the indicator and scanner is available for Thinkorswim, for TradeStation, and for NinjaTrader. What I was saying about the dashboard is, so this is what it's available for right now. The dashboard is something we're working on. It's a big, major project. It's just an FYI. There's no offer here, right? It's just, I'm telling you, once this is ready, the gap indicator will also be loaded on our dashboard, okay? And then if you want to use the dashboard, you can subscribe to that, and then that'll be on there as well. And that'll be platform independent, Robert. Does that make sense? Because a lot of people, have platforms that we can't program for. So by having our dashboard, then that's going to make it much easier for people to not have to try to install stuff on their computer. Okay? Yes, Nestle. Yeah, Nestle's asking. He or she's saying that she purchased this course in April. Yes, absolutely. So just to be clear, guys, once you purchase this, you'll be entitled to any future webinars, any of these. So yes, you're going to get an email sent to you, Nestle. Absolutely. Okay? Does that make sense? Peter's asking, how far out in expiration do you go on if I buy an option? I usually go out about at least a month or so. And that's not because I'm looking to hold the options that long. It's just because I like to just be safer. It's just I don't want to get killed on it, so it goes against me. But again, this is not an options trade necessarily, right? Like you can just buy the stock. Like for example, today in Twitter, I just bought the stock. And again, this is all. We'll talk about all these details in the bonus webinars. Okay. Let's see. Does it work on futures, Sanji? Yes, absolutely works in futures. Absolutely works in futures. Absolutely. Like for example, if you get a signal in like one of the indices, right? You just do it on you execute on the futures, right? James is asking, he's saying that he's very interested once you have the dashboard. So here's the deal I'm making to you guys right now. anyone who is joining this today, because the price is going to go up in the future of this, I think after 25, so we have 25 at 197. In fact, we're probably going to add a few more, because right now I think we're already at like 22. You guys are purchasing a lot of these. We're probably going to make another 5 or so available. If you purchase this today at 197, you're going to get the dashboard for a couple months for free, because the dashboard is going to cost something per month. It'll be like $35 a month or something like that. I'm not quite sure. But if you join it today, you'll be able to get that for free for a couple months. Okay. Cool. Let's see. Gordon. So does that make sense, James? Just so you guys know, that's kind of the deal we're making here. Gordon is asking, when will the watch list show up in the morning? Oh, I see. Okay, great. Let's go back to that again. So Gordon is asking, when will the watch list show up in the morning? The watch list starts to populate within the first minute, and then you'll get more signals within the first 5 minutes, 10 minutes, 15 minutes, 20 minutes. This is so this doesn't just populate right away. It takes some time, but there's a reason for that. It's an additional filter. I did this on purpose so that it makes me more patient. The juicy gaps, the ones I care for, they don't fill in 2 minutes. They don't. They're not worth it. The gaps I'm talking about are these, like the ones that I showed you. Twitter. Look at this. Twitter took 5 minutes, 10 minutes, 15 minutes, 20 minutes, 25 minutes to set up, right? Does that make sense? Gordon, was it Gordon that's asking that? Yeah. Rodney, I'm not quite understanding your question about fill rates, but like I said, it's the way it works is that we know the statistics, and once you learn the exact strategy, which is all in the course and in the bonus webinars, we know that if you do it by that strategy, the odds of you making a successful trade are somewhere between 85 and 90%, right? And then I personally like to go for the half gap, right? But you can also go for the full gap. Yes, Sanji, you can install this on several computers. Now, if you install this on a ton of computers, we will have a problem with that. But you can install it for your personal use. You can install it on up to, let's say, 3 computers. That's kind of what we say. Right? That's more or less the Microsoft Office way of as well. Okay. All right. Cool. All right. What other questions you guys got? So again, let's just kind of go through this one more time so you guys can see how this works. All right. So what we do in the morning, we come in. We come into the morning and we look for opportunities. So this morning, what struck me very quickly was Twitter. Okay. It popped up. It was one of the early ones that popped up, and I saw the market kind of bounce a little bit. So I gave this a few minutes. And after 25 minutes, we traded it, right? And this gap was juicy. I mean, once we got in, this gap still was 1.7%, right? That's a big trade. And we bought the stock this morning on that. You could have just bought an option, an at-the-money call or a call spread expiring, at some point over the next month or so. Not because we're holding it that long, but because we like to be a little bit more on the safe side. Does that make sense, folks? Yeah? Okay, excellent. Okay, well, listen, guys, that's what I wanted to show you folks today. Again, if you want to join us today, it's $197. The price, once we reach the 20, we're going to make a 30 available because we just reached 25 mark. So if you guys want to get this, the offers are open for another hour or so, and again, the price will go up. So for those of you guys that were referencing the dashboard, I saw a bunch of you guys. The dashboard's not available yet, but it's just for those people who don't have one of the platforms that the scanner is available for. So if you get this now, you will also give you a couple months of the dashboard for free once it's available, and that's going to then allow you to be able to use the indicator and the scanner on our website when you log in, and so you don't have to have a specific platform, right? So that's that. Okay. Cool. Hey, Peter, that's a good question. I mean, I'm not quite sure, which specific stock you're referring to, but like, this was a 1.7% rally in Twitter, right? So when we got in to the point where the gap closed, that was 1.7%, right? And you could have bought some stock. You could have bought a call option, I mean, that's a meaningful rally. For those are the kind of gaps we're talking about. And again, you guys will learn all about that in the course, in the bonus webinar. We just there's only so much I can go through in an hour, but yeah. So make sure you join us right now. The offer's good another hour or so. I think like I said, we have 30 to go at this price. It's the century.com/gap, and again, it includes the indicator and the scanner. So thanks for joining, folks. Great crowd, amazing questions. Have a great rest of the day. And for those guys that are joining, I will see you guys at the very latest on July 24th, which is when we are doing the next live bonus session, live trading the gap. And of course, in the meantime, hopefully then you've watched the course and you will have installed the indicator and the scanner. And yeah, cool. All right, guys, have a great rest of the day and take care.